Welcome, everyone. This is what I like to call advanced Social Security, or Social Security 102, I guess it would be, instead of 101. Today, I'm going to briefly, the first 10 minutes, I'll review what we discussed in Social Security 101, and then I'll jump right into what I consider advanced, or essentially reviewing different parts of Social Security you may not be as familiar with, survivor benefits, spousal benefits, and then give you some rules of thumb when you're thinking of your Social Security, when you're thinking of your Social Security benefit, and best ways to take that benefit. All right, so I'm going to jump right in here and move this over here. All right, so quick review on the basics of Social Security here. First of all, the main problem here is people are hurting their retirements by making terrible, costly decisions when it comes to Social Security, using friends, CPAs, attorneys as their primary source of information regarding Social Security, and that can lead to some pretty disastrous consequences, especially when you think of Social Security as a benefit, a lifetime benefit, not only for yourself but as with your partner or your spouse as well. So things to know about Social Security: you have a lot of claiming options, right? Far-reaching consequences. Impacts both spouses. I think a lot of people think of Social Security in the context of their primary benefit only, and not in the context of their spouse. It's not bankrupt, nor is it a Ponzi scheme, and the benefits are likely will help a family member down the road. And just remember, when it comes to expertise, there's very few experts in this area, and it's something that you certainly should have an analysis done if you're thinking about claiming your Social Security benefit, or if you have questions, please seek out answers from an expert, myself included, or anyone that is a Social Security expert. And again, I just want to reemphasize, attorneys and CPAs, by way of their profession, are not experts in Social Security. I've lectured a lot on Social Security to those two groups, and there's a lot of, I would say, misinformation out there. So what are the different things that baby boomers want to know about Social Security? Will it be there for me? How much can I expect to receive? When should I apply? And then we'll talk mostly on these last two, how can I maximize my benefits, and will it be there enough to live on in retirement? And the simple answer there is most likely for most of you, no. All right, so will it be there? This is the OISD Trust Fund. Again, I'm going to fly through this beginning, because if you have more questions on the beginning part of the presentation here, you can go review the YouTube on Social Security 101. But trust fund balance, $2.9 trillion. You can see here, as of 2020, there was a net increase in assets of $10.9 billion, ending on 12/31 of 2020. And this is during, obviously the pandemic, and a lot of people unemployed, and the trust funds still continue to increase. When people think about a Ponzi scheme where they say, hey, it's not going to be there for me, or possibly not, that's just simply not true. And the reason it's simply not true is, as everyone continues to work and pay Social Security income tax, or Social Security taxes, wage taxes, I should say, your FICA taxes, that immediately gets turned over to beneficiaries, meaning it gets turned over to those that are receiving Social Security benefits. The issue is that the expenditures are projected to the cost is projected to greatly increase over the next decade or so, as the baby boomers in earnest enter retirement and the income does not increase. And so by 2034, the Social Security trustees are predicting that there will only be enough coming in to suffice 79% of benefits. Now, that being said, what are some of the ways that it can be fixed? Different reform proposals increase the maximum earnings subject to Social Security tax. This already goes up every year. It's in the 150,000 range for 2023. Raising retirement age, that's already occurred as well when Social Security started in 1935. The normal retirement age was 65. Now it's 66 if you were born before 1954. And from 1954 to 1960, it stair stubs up to 67. Lower benefits for future retirees. That's probably the least palatable one, or the least likely one. And then reduce the cost of living adjustments, or change the way in which cost of living adjustments are calculated. Bottom line, benefits are not likely to be affected by Social Security reform if you are a baby boomer. All right, so a couple other things that we reviewed in the first presentation was your benefit will depend on how much you've earned over your working career and the age at which you applied for your benefits. It's the top 35 years of earnings. So if you have not worked for 35 years or contributed to Social Security for 35 years, each year you continue to work will increase your benefit. how the benefits are calculated. It's called the AIME formula, not necessary to know, but again, it's the highest 35 years of earnings. It's calculated using 3 different bend points, and the Social Security Administration is the source of information to tell you exactly what your benefit will be. All right, so when should you apply for benefits? We discussed in the first presentation. That's based on health status, life expectancy, need for income, and then again, whether or not you plan to work, and most importantly, and this is what I think you should think of Social Security in the context of, is your survivor days. So will it be there enough to live on in retirement? Simple answer is probably not. This is another one of the things from the first presentation that we went over, full retirement age, that I think is a very important slide to understand. If you were born 1954 or prior, your full retirement age is 66. Then you get the stair step up into 1960, where your full retirement age becomes 67. Right? If you apply for early benefits and your full retirement age, we'll just take the example of 67, right? You apply at 62, you get what's called the actuarial reduction, or you get a 30% reduction in your benefit. You get 100% of your primary insurance amount, which is also the same or the equivalent to your Social Security at your full retirement age. And so any year that you choose to take it prior to full retirement age, you get what's called the actuarial reduction. Now, if you delay benefits, meaning you decide to wait, you get this delayed retirement credit, delayed credits, right? You get an 8% annual delayed retirement credit, and you also receive the cost of living adjustment on top of that, which has averaged about 2.9% since 1982. Last year, it was significantly higher, almost 9%. So the way I like to explain it to folks, when you're thinking of Social Security and delaying it, you're essentially getting an 8% plus the cost of living adjustment, let's call it 3%, an 11% rate of return on your benefit, right? And that's why a lot of people, I think, that take Social Security early don't understand the concept that you're getting compounding returns on your Social Security benefit. So, for example, if your full retirement age is 67 and you wait till 70, you get 124% of your benefit, but you're actually going to get significantly more because you're also going to get the cost of living adjustment. So how do you estimate your Social Security benefits? Again, I just told everyone, go to SSA.gov, click on the estimate your retirement benefit, or use one of the calculators on the SSA website. So why would you want to delay benefits? You get bigger checks to start, right? So if you, again, if you plan it two, sorry, did somebody have a question? Or somebody not on mute, I take it? Oh, okay. Vanya, if you will, let me know if somebody writes a question in the chat, since I'm flipping to the slides here. Let me know if someone has a question. And by the way, this presentation is for all of you. So if you do have a question, please don't hesitate to stop me and ask. So again, bigger checks to start. So if you claim at 62, right, and this assumes that your primary insurance amount is $2,800, right, and it also assumes a cost of living adjustment at 2.6% annually. When you start your checks at 62, you're going to start out with $1,960, whereas at 70, right, you may see on your statement that it's $3,472, but in actuality, if we add in that cost of living adjustment, and this is probably pretty low, you're going to be around $4,263 in checks, which is, you know, over double what your check would be at 62. Then someone will say, well, I'm not getting any benefit then from 62 to 70, so how do I supplement that income? And that's exactly what we're going to go over towards the end of the presentation today, some ideas around that concept. Again, you get more income later on when you delay benefits. And so how can you maximize your benefits? Again, review your earnings record on SSA.gov. Is it accurate? Are there any missing years? And this is the one that's the least popular, is can you improve it by working longer? Can it continue to work? Applying for Social Security at the optimal time. We'll go over a couple of rules of thumb in today's presentation when it comes to claiming Social Security benefits. Bottom line is I do free Social Security analysis for any retirement association or Maritime Association members. So if that's something you would like to have done for you, it's free. It's part of the service to UCSD. Paul, you have a question or your hand's up? Would you like to ask a question?
You might need to unmute yourself.
There. Can you hear me now?
There you go.
Yes,
I can.
It made it sound like, from what you were just showing, that if you put off your Social Security benefit, let's say I'm 64 and I didn't get it for 3 years, that the cost of living expense would be added to that amount each year when I'm not getting it? I didn't think that was the case. I didn't think
You mean the cost of living adjustment, right?
I didn't think the COLA was added to the amount. I didn't think that made a difference in terms, if you're not getting it, I didn't think that was added to the adjustment. Was it?
So
Is
the
it?
COLA, if you're not currently claiming Social Security and you are delaying it, you do get the cost of living adjustment. And this is why I tell people the statements you used to get in the mail that you can download from the Social Security website is incorrect. Okay, and what I mean by that is the only day or the only number on that statement that's correct, and I jumped back here. Let's say you got a statement right now, and your primary insurance amount is this amount down in the bottom right hand, $2,800. Okay, and the cost of living adjustment is 2.6%. Your statement is going to say that your benefit, if you claim it at 62, is $1,960. It's going to say at 67 it's 2,800, and at 70 it's 3,472. But these numbers are all incorrect. The only one that's correct is the one at 62, and that's on the day you turn 62, because the cost of living adjustment is not added in those statements. So the Social Security statements that are provided to beneficiaries, us, right, are incorrect in that they do not have a cost of living adjustment in them. Okay. Now we say, well, why doesn't the Social Security Administration add in the 2.6% annual COLA? Well, because they don't know what the annual COLAs are. And can you imagine if they started giving statements out to people, assuming the COLA from last year, 8.9% or whatever it happened to be, or do they take an average, or do they just say 2% across the board? So what they've chosen to do is not add in the COLAs on your statements. And that's why I tell people your benefit is actually going to be significantly larger than you're estimating it in the future. Again, sorry, go ahead.
That's really good news. Except what I did notice is that when I checked it each year, when I wasn't getting it, it didn't look like even 2 years later, it wasn't taking in,
I'll put my ears in. It's Ryan. He's doing an advanced Social Security.
What?
Somebody's not on mute that needs to be on mute. I apologize there.
Oh.
Do you want to continue with your question?
So the question is, I was wondering, so what you're saying is it's included, but what I did notice is, like, if I'm 62 and look at how much I would get when I was, let's say, 67, and I check again when I'm 64, it didn't change. Shouldn't that change if the COLA is included? That it would, or they never change that on their estimate, even the years after the COLA has already happened? They don't adjust it?
Yeah, so this is a great question. Let me explain to you what's happening. So your benefit is based on this primary insurance amount that you see in the right corner. So if you're not continuing to work after, let's again, say you're 62 and you retire, but you don't claim your Social Security benefit, and you don't continue to work and improve your earnings record, then your primary insurance amount is not going to change. The actual benefit that you will receive will continue to change with the cost of living adjustment, but your primary insurance amount does not change, and that's why you don't see the change in that number. Does that make sense? I hope.
Yeah, it's actually, this is an eye-opening thing for me, because it means it makes more sense to wait longer based on what you're saying.
I'm glad you said that, because that's exactly what my advice to probably 97% I've probably done over the years, over the last, and Bonnie, I got to get the my bio done again, because I've actually been in the industry now 15 years, not 11. But you're exactly correct in that it's the benefits that are listed on SSA are misleading in that they are not correct to what you will actually get, even if you continue to delay. And as I said, I've probably done 500 Social Security analysis for UCSD members, Retirement Association, and the Maritime Association members. And what I can tell you is 9 out of 10 times, the advice to delay claiming benefits is usually the right advice. There are the occasional times when I tell someone, you should probably claim your benefit now, but the majority of the times it does help to delay. And I know there are people out there probably watching this, and they'll say, well, but what about all that missing income from 62 to 70 or from 67 to 70 or whatever it happens to be? I'm going to address that as we get later down in the presentation and why it catches up really quick. And most importantly, you have to think of it in the context of not just yourself, but the context of your survivor benefit for your surviving spouse as well. All right. So again, kind of rushing through a little bit here, what we covered. And again, these concepts that I'm going over right now, full retirement age, primary insurance amount. If you have more questions on that, I'd encourage you to go to the YouTube channel. Vanya, you could probably put in the chat a link to it. I did the 101 presentation and spent a lot more time on those concepts last week. Okay, so finally, reviewing last presentation, let's talk about taxation of benefits. Very important to understand, if you are prior to your full retirement age, whether it's 67 or 66 or 66 in several months, and you make a modest income, and I say modest, let's call it $50,000, your benefits are going to be pulled from you due to what's called the earnings test. If you claim your Social Security benefit before your full retirement age, your Social Security benefit is withheld if you're over a certain amount of income. That amount changes based on if you're 62 or 65 or, you know, in the year that you achieve full retirement age. But I want you to, you know, consider delaying that if you continue to work, okay? Now, once you've hit full retirement age, there's no earnings test. You can make $10 million a year and you'll get your full benefit unrestricted. All right, so taxation of benefits. This was so the taxation benefits came, I think, in 1982, 1981, and they did not index it for inflation, so these numbers are pretty low. Based off of what's called the provisional income formula, you can see down at the bottom, it's adjusted gross income plus 1/2 your Social Security benefit plus tax exempt or municipal bond interest. And for most of you, you're going to be over this 44,000 essentially in adjusted gross income, or provisional income, I should say. Up to 85 cents on the dollar is taxed at your ordinary income rate. That's not 85% is taxed. So if my Social Security benefit is $1,000, then 85% of it, or $850 of it, is taxed at my ordinary income level. So let's say it's my marginal rate's 25%. So that $850 would be taxed at 25%, not the entire thing. So Social Security is tax advantage from a federal standpoint, and even better in the state of California. The state of California does not tax Social Security. So Social Security benefit is actually significantly more tax advantaged than almost all of your other retirement assets, except for maybe a Roth IRA or maybe some dividend income or long-term capital gain income. All right. I'm going to skip that because that was in the last presentation. Just remember, Medicare is going to shrink your check based on once you achieve Medicare age, because your Part B premium is automatically pulled out of your Social Security check. If you delay Social Security to 70, you obviously have to arrange the Social Security Administration to pay your Part B premium to Medicare, because you must start that at 65. There's some exceptions to that, and that's discussed. I'll be discussing that on Monday in my Medicare presentation. All right, so key points to remember when applying for Social Security: apply early, your benefits start lower, and most importantly, they stay lower for life, right? We're living longer lives, so it makes more sense, potentially, depending on your individual situation, to delay claiming your benefit, because the COLAs, as it says here in the second bullet point, they magnify the impact of earlier delayed claiming, right? The longer you can wait, the more beneficial it is to delay benefits, right? Your benefits are taxed, right, and reduced due to Medicare premium, but not taxed in the state of California, so it's a tax-advantaged source of income in retirement. Don't let the earnings test discourage you from working, or you think of it the reverse of that, the earnings test should discourage you from not working, or excuse me, should make you reconsider if you are working, claiming your benefit, because the earnings test will potentially reduce or eliminate all of your benefit. And delaying benefits may give the surviving spouse, and this is very important, more income in the form of survivorship, okay? So for couples, you should always maximize, this is the first rule of thumb for today, you should always maximize the higher earner benefit to protect the surviving spouse. So, and it doesn't matter if the higher earner spouse is younger or older, as a rule of thumb, they should delay, if possible, to 70, because they provide a survivor benefit, not only for themselves, but for the surviving spouse. So what are spousal benefits? And remember, there's two different ones I'm going to talk about. There's spousal and survivor. Okay, so let's talk about spousal benefits. spousal benefit is half the primary worker's primary insurance amount if started at full retirement age. So going through an example, John's primary insurance amount or his amount at full retirement age is $2,000. Jane's is $800. If Jane applies at her full retirement age, she's going to get $800 plus what's called the spousal add-on. So her benefit will be 50% of John's, or it will be $1,000. What are the rules surrounding spousal benefits? So the primary worker must have filed for benefits. The spouse must be at least 62. And if you claim spousal benefits, remember on this last slide, she claimed her benefit at full retirement age, assuming, let's say, at 66. But if she claims early at 62, they're going to reduce the benefit that she gets as a spouse. She's not going to get 50%. She may be 30%, 35%. Social Security can tell you exactly what that number is going to be, but she's not going to get the 50% unless she waits till her full retirement age. Very important concept. There are no delayed credits on spousal benefits. So spousal benefit should always be claimed at full retirement age and never wait a day beyond, because you don't get delayed retirement credits on spousal benefits. You do get delayed retirement credits on a survivor benefit, which is, again, why this rule of thumb for couples always maximizing the higher earner's benefit, right? That is because survivor benefits do get the delayed retirement credits. All right. So coordinating spousal benefits. Let's look at one maximization strategy where the lower earning spouse's primary insurance amount is more than 50% of the higher earning spouse's primary insurance amount. In this case, it'd be best for both spouses to delay to age 70 and one spouse takes advantage of spousal benefits as allowed. Now, the whole file and suspend and filing a restricted application has pretty much been eliminated as of 2016, so you can't do that as much. But again, this is if the spouse's primary insurance amount is more than 50% of the higher earnings spouse's primary insurance amount, right? Now, the hybrid strategy is where the lower earning spouse's primary insurance amount is less than 50% of the higher earning spouse. The lower earning spouse claims early, and the higher earning spouse claims at 70. This generates income sooner while maximizing higher earning spouse's benefit over both lifetimes, right? And so, again, this is an example of the maximization analysis that we do. So if you're interested in that, I will put my email in the chat. Again, it is a free service, specifically that Suzanne Chaffee had me start 12, 13 years ago for the RA and the Retirement Association as well. So that's something that's available to you if you so desire. All right, so now let's talk about survivor benefits. I'm widowed or divorced. How does that impact my Social Security claiming strategy? Well, if you're widowed or divorced, you're eligible for survivor benefits or divorce survivor benefits or divorce spouse benefits that can increase your monthly check. All right. So survivor benefits are very, very, very complex. I'm not going to go too much into depth. If you have specific questions, please don't hesitate to ask. Oh, Bonnie, you put that stuff in the chat. Perfect. Thank you. So the survivor benefit will depend on the age at which the deceased spouse originally claimed his or her benefit, called the original benefit, right? And if he claimed after full retirement age, the survivor benefit will include the delayed retirement credits. So again, that higher earning spouse traditionally should wait till 70 to claim their benefit. There's no benefit, by the way, for claiming a single day after age 70. That's the last day that you want to wait on claiming your benefit. There's no benefit to waiting to 71 or 72 or anything beyond that. All right. Survivor benefit will also depend on the age at which the widow claims the survivor benefit or the actual benefit. If she claims before her full retirement age, her survivor benefit will be a fraction of the original amount. If she claims at full retirement age or later, her survivor benefit will be equal to 100% of the original benefit. Now, if you're not confused and that's not complex enough, I totally understand. It took me the better part of 2 years to really, really get my hands around Social Security and understanding all the nuances. So if survivor benefits confuse you, I would encourage you, to send me an email in your personal situation. I'd be glad to address any questions. All right. If a spouse dies while both are receiving benefits, the widower may switch to a higher benefit. Here's an example. Joe and Julie are married. Both are over full retirement age. Joe's benefit's $2,000. Julie's is $1,200. Joe passes away. Julie immediately notifies, and her benefit, she doesn't get the $2,000 plus the $1,200. She simply moves from $1,200 to the $2,000 benefit. All right. Basically replacing his benefit. Now, here's an example of delayed claiming. Joe and Julie are married. Joe's PI is $2,000. Joe files for Social Security at 70. So his benefit is 132% of 2,000 or 2640. As we just discussed with a really good question from the gentleman earlier, it would actually be more than that because the COLAs would be included, but we're just using it as an example. Julie's survivor benefit would be equal to Joe's benefit of 2640, right? As long as she claims at 66 or later, she'll get the full 2640. Survivor benefits, spousal benefits start at 62. Survivor benefits can be claimed at 60. And if she claims at 60, it'd be 71.5% of 2640 or 1887. You say, well, why would she do that? Well, what if she had her own benefit, let's say 3,000, right? She can claim her survivor benefit at 60 and get 1887 from 60 to 70, and at 70, she could switch to her own benefit, which will be much higher and will have delayed retirement credits. So pairing these things together becomes very, very complex, and it requires knowing a lot of the nuances of Social Security. So again, I encourage you, if you have a question, to please email me. All right, so a couple of rules around survivor benefits. Couple must have been married at least 9 months at the date of death, unless it was like a car crash or a plane crash or something like that. Survivor must be at least 60 for the reduced benefit, 50 if the survivor is disabled, or full retirement age for the full benefit. We just discussed that. And a survivor benefit not available if the widower remarries before age 60. So if you are a survivor and you're approaching 60 and you're a widow, I should say, and you're eligible for survivor benefit and you're approaching age 60, you may want to hold off and get married after 60 and after you claimed your benefit. All right. And divorced spouse benefits are available if the marriage lasts at least 10 years. Right. My wife and I are celebrating our 10-year anniversary on September 28th of this year, and therefore she'll be totally entitled to any Social Security benefits that I would have been entitled to if I were to suddenly pass away. As well as my military pension as well. That also requires 10 years. So here's the divorced spouse benefit. It's the same as the spousal benefit as long as the marriage lasted 10 years. The person receiving the divorced spouse benefit is currently unmarried, and the ex-spouse is at least age 62. If divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So what does that mean? Let's say you've been divorced for 10, 15 years, and you've had a not so amicable breakup, and you don't speak to your ex-spouse, but you remember that they are turning 62 this year. And let's say you're older and you're, let's say 66 or 67. You can actually, as soon as they turn 62, you can go file for your spousal benefit and claim that spousal benefit and delay your own benefit. That spouse that you did not amicably split with would not be notified whatsoever, and it does not affect their benefit whatsoever either. There's the old story of Johnny Carson. I think he was married 3 or 4 times, and all 3 or 4 of his ex-wives were claiming on his Social Security benefit. The rules for divorce spouse benefits: more than one ex-spouse, which is the example I just gave, can receive benefits on the same worker's record. My father and mother were married for 12 years. They divorced. My father's remarried for almost 30 years now. And my mother is actually, she just turned 70 last year, and so she's on her own benefit now, but she was one of those people that was grandfathered into a restricted application, and she was claiming on my dad's record for a long time, even though they divorced in the mid-'80s. Benefits paid to one ex-spouse do not affect those paid to the worker, the current, or other spouses. And remember, they also are not notified. Divorce spouse benefits stop upon remarriage of spouse collecting the benefits, not upon the remarriage of the primary working spouse. All right. Gee, this is really more complicated than I realized. Yes, I know that. So again, in life, would you rather be early or delayed, pay a penalty, or get a bonus? Equate early claiming as a penalty and delayed claiming as a bonus, right? So insights, again, Social Security offers inflation-protected income you cannot live, including benefits for survivors. Remember that monthly benefit, if you claim early, will be reduced for the actual reduction, and it can be significant. If your full retirement age is 67, it's a 30% reduction in your benefit. Whereas if you wait from 67 to 70, you get a 24% increase, plus the cost of living adjustments continue to accrue. Couples should always maximize the higher earner's benefit to the surviving spouse. That's the one major rule of thumb that I've given you today to remember. If you're widowed or divorced, you may be eligible for those benefits. Please, please, please email me or give me a call, and I'll be happy to walk you through what the best way to claim is on that. All right. So this is where I'm going to end today's presentation, considering Social Security in the context of all these different, and this required minimum distributions, by the way, are at 72. I have not updated that slide, but I will do that. I'm now going to do a new share here. I'm going to go to the whiteboard, and the crux of advanced Social Security planning, I think, is really thinking of it in the context of your overall retirement plan. So this is where we used to be, we'd have somebody just sent, okay, Rose, I just received your email. Thank you. I'll get to that after the presentation. So I want you to think of this as your retirement. You're getting ready to retire from UCSD. I know most retirements, I believe, happen at the end of June, I think it is, June, July, because it's when the pension is maximized, if I remember correctly. Here are all the sources of income we have for retirement. So let's go through some of the sources of income we have in retirement, right? We have, if you're a UCSD alum, you're going to have your UCSD pension, right? You have maybe you've done some saving in the 403, the 457, or the DCP, right? And you roll all of that out because you know it's better to consolidate your assets in retirement and give yourself a lot more choices than the 403, 457 plan allow. So you can consolidate all those assets into an IRA. You have Social Security, which we're talking about today, if you did participate in Social Security. And what are some other sources of retirement income? Yeah, maybe a Roth IRA. Maybe you have some like real estate income from a rental property. And maybe I want to put a T here. It could be a brokerage account, but think of this as a trust account. Hard to write on the computer screen, so I apologize for the bad writing. But so these different sources of income, like if I'm getting real estate income, how is that taxed, right? Well, at the California level, right, it's ordinary income. And we'll do California at the bottom, and we'll do Fed on the top for all of these. And at the federal level, it's ordinary. Yeah, you may get some advantages in real estate, leverage, depreciation, but you also have, when you sell, you have depreciation or capture and all that stuff too. So this is not really a tax advantaged income. Your trust account, right? Well, California, lovely California, does not recognize capital gain, long-term capital gains, or dividend taxation rates. California makes everything ordinary income, okay? At the federal level, you may have some long-term capital gains that's tax advantage, right? Maybe it's at 15% or 20% or 23.8, depending on your overall income. And you may have, special, qualified dividend rate, something like that. But again, it's not tax advantage in California, but at the federal level, okay, so this has a little bit of a tax advantage to it. All right, I'm gonna skip Social Security, go to pension. Everything that comes out of the pension at the federal level, yep, you got it, ordinary income. At state level, you got it, ordinary income. IRA, same. Federal level, ordinary income. State level, ordinary income. What about Social Security? You guys remember the taxation on Social Security? At the federal level, remember it's 85 cents on the dollar at your ordinary income level, okay? And California, not ordinary income, makes that zero. Right? So this is the most tax advantage, unless you have a Roth IRA, a large Roth IRA, which they really don't exist, large Roth IRAs. There are some out there, but not many. This is the most tax advantage retirement income you have. And let's think about, and so I'm going to clear this for a second. Let's think real quick about retirement. We spend our whole life building our retirement, and we get to this inflection point, and then we distribute our assets, right? So here, we're putting into our retirement plan, we're putting in our retirement plan, we're putting in our retirement plan, we're putting money away, and then right about here, we retire, and then what do? We take money out, we take money out, we take money out, all right? I used to always call this the accumulation phase, right? And this is the distribution phase. And right in the middle, I call it the IP, or the inflection point. And this is where retirement decisions are made that either keep you on this retirement track that you want, or they take you down here and they put you on this retirement track, right? Which is not desirable. And the type of decisions that are made up here, everybody's familiar with it. It's, having a portfolio that consists of nothing but tech stocks in 2000 or 2022, owning nothing but the ESG and tech funds that were in the Fidelity plans. They were all down, 30% roughly last year, right? So we do things in our portfolio to protect ourselves, but what are we also doing with our different sources of income? Are we using them to protect ourselves too, right? Because we don't want this to happen, right? Because this down here, this is the go back to work line right here. We don't want to do that. We want to stay on our retirement on this plan, what we've been planning on for our entire life, all right? So going back again to my different buckets, right, for retirement, Think of this real quick. When I go back and I say pension, and remember the IRA is a combination of 403, 457, and DCP potentially, Social Security, real estate, right, and trust account. Of all these assets, which the most guaranteed of all of these? Some of you may say, well, my pension is. Well, who's the pension backstopped by? Oh, the state of California taxpayer backs your pension, okay? So that's all 33 million of us. There's 330 million people in this country backstopping Social Security, guaranteed by the full faith and credit of the United States government. I've already told you that from a tax standpoint, right, it has much more benefit, right? It is much more tax efficient than your pension or your IRA. What's the problem? Who backstops the IRA or your investment plan, right? No one does, right? So you're subject to risk. You're subject to market risk. I'm guessing most people in 2022 were down double digits percentage in their portfolio in their IRA. So there's no protection in here whatsoever. I mean, obviously you can put an annuity in a retirement plan. You can do all these different things. But the bottom line is it's not backstopped by the U.S. taxpayer or the California taxpayer. Trust account has the same thing, essentially, or brokerage account, whatever you want to call it, as the IRA. So now, and real estate, as we saw in the 2006 to 2008 debacle, real estate can have a lot of risk associated with too. What if you don't have a renter for a couple of months? What if you get a renter that destroys, the house, and you have 2-3 months of no income, or just natural turnover between tenants? You have a couple of weeks or maybe a month between different tenants, right? So I like people to think about their retirement as they get older, in their 70s and 80s. Where do you want most of your retirement income, this stuff right here, where do you want it coming from? You want it coming from these guaranteed sources. You don't really have any ability to change your pension, right? But by claiming Social Security later, you're putting less stress on these risky assets, right? By substituting a dollar for today for a dollar for tomorrow of Social Security. What do I mean? Well, from 62 to 70, why not delay taking Social Security, get that increase, again, if your full retirement age is 66, get that 25% increase from 62 to 66, plus the 32% increase in your benefit from 66 to 70, why not take money out of your IRA and wait and delay your Social Security until 70? So that in your years from 70 to, question mark, let's call it 85 to 90 or whatever, you're getting more of your retirement income from a guaranteed source that has zero risk. What are the other problems with these other than market risk? What are some of the other problems? Does Fidelity give you all those wonderful mutual funds and everything and all their advice for free? No, right? Does my company give the advice for free, and are there different investments, ETFs, all that stuff, are they free? No, right? So by substituting a dollar of your IRA from 62 to 70 for a future dollar of Social Security, you're not only reducing your future fees and expenses in your retirement accounts and your brokerage accounts, you're significantly reducing risk in the longevity of your portfolio by transferring risk from variable instruments, meaning stuff that's invested in the market, to guaranteed income supported by the full faith and credit of the United States government. Again, over here in my bottom right, and this will be the end of my lecture, Social Security is tax advantaged. It comes with 100% survivor. Let me actually just clear this, and we'll just go through, because I want to leave you with this. Here is the crux of the presentation. Why did delay Social Security, or consider delaying it? 1, tax advantage. No state income or no income tax in California, and at the federal level, tax advantage. 2, 100% survivorship benefit if you wait to the right time for your surviving spouse, right? 3, 330 million people backstopping your Social Security benefit. Full faith and credit of the United States government. And here's 4, when you delay your Social Security benefit and you draw down of your IRAs earlier, you are doing 2 things, right? You are creating more guaranteed, I'll just put GI, more guaranteed income in your portfolio from the standpoint of you are switching out a portfolio dollar that is invested in the market, right? And you're moving it to a Social Security dollar that's guaranteed, and you are reducing your future fees and expenses. Sign me up, right? Sounds like 4 really, really good reasons to consider delaying your Social Security. And with that, it's 12:42. I will open up the chat here for questions, concerns, emotional outbursts, anything else?
Thank you, Ryan. That was
Chairman
very
Cook?
informative. So I'll go ahead and let people put their questions in the chat. Otherwise, is it fine for them to unmute themselves as well?
Yeah, yeah, or they can unmute themselves and somebody wants to raise their hand and then just ask a question. I'm happy to do it any way. Well, this is for all of you. So if you don't want to ask a question here in front of anyone else, that's fine too. You feel free to send me an email or give me a ring, and I'd be happy to answer individual questions. Not everybody at once. All right, I'm not seeing anything pop up. Oh, there you go. Thank you, Barb. Oh, yeah, my buckets. That's proprietary, by the way. Those are Ryan's buckets, so you can't tell anyone else about that. You have to come to the presentation for those.
Ryan, can you
Yes.
hear me?
Yes, please. Yes, I can.
Forgive me if you covered this. I'm looking at your flyer and it says one of the strategies is file and suspend. So is that regarding the Social Security? If you file for Social Security, that you can suspend that? So if you've done it,
Yeah,
you can
so file and
basically
suspend
stop it?
File and suspend was eliminated in 2016. So when I started doing this presentation in, I don't know, 2009, 2010 for UCSD, we used to always go over file and suspend and filing a restricted application. Congress got smart to that and finally eliminated that provision.
Okay. I'm glad I asked. Thank you.
We will need to update our
Thank you.
flyer,
Thank you.
so thank you for that.
Yeah. And Vanya, please do send me an email to get you an updated bio too. That's going to be a little bit more.
Of course. And then Paul, you had a question?
Yes, thank you
Yes,
for that
Paul.
very informative presentation. I thought I knew most about Social Security, and I learned I didn't. You got into these complexities that I knew nothing about. This is back to the question I asked originally about the cost of COLA that's added on each year. And that apparently when you go to the Social Security website and you find out how much you would get at each year when you retire, you're saying it's not correct because it doesn't calculate in the COLA. Is there a way to calculate that? Can you get someone to calculate that for you so you actually know what the amount will be, so it's right?
Yeah, you email me and I give you it's a simple worksheet that you fill out, and then I can estimate the COLA and I can move it around. I can make it 4%, I can make it 3%, I can do whatever. Social Security Administration will not do that for you.
Oh, is that included in the free meeting?
Yeah, it's not a free meeting, it's just a free analysis. Yeah.
Oh, free analysis. There's no cost for that. Okay, I'll definitely contact you. Thank you. That would be very helpful.
Yeah, absolutely. iPhone Bruce, I like that name, by the way, iPhone Bruce. Does your recommendation still hold if Congress extends retirement age? Well, Congress has extended retirement age, as I said in the beginning of the presentation. 1935, Social Security began. I forget the very first person to claim Social Security. She literally turned six. It's your story. You can go Google it, but her name was like Ida May or something like that. And she turned 65 in 1935. And she got the very first Social Security check as soon as they created the Social Security program. It's an interesting story if anybody has a desire to read that. But so it was originally 65. They moved it to 66 for full retirement age. For Vanya and I, it's 67. I would expect down the road, it's going to probably, even for my generation, Generation X, I'm 46 years old, 46 and a half. I would expect my full retirement age to be higher at 67 by the time I get there. Will there be a grace period, man? If I could tell you what Congress is going to do an hour from now, I'd be a very wealthy man. But unfortunately, it's very, very difficult to predict what the infinite wisdom that is our Congress will do over the next, decade or years to shore up Social Security. It is a big, hot political football, but I think if you take anything from this lecture regarding the efficacy of Social Security, is it is not going bankrupt, and it's not a Ponzi scheme. There is a lot of money. I mean, there's still $3 trillion in the Social Security Trust Fund, and each year the trust fund takes in hundreds of billions of dollars in Social Security wage taxes. So, there are things that need to be done for the long-term health of the program, one of the solutions that I did not mention that is very, very important for this country is immigration, because we're not having as many children as we used to. And so one of the ways to shore up Social Security is for there to be more people in this country legally contributing to FICA taxes. So do we have any more? Please step in if you have a question. I'm more than happy to answer it. I'll stay on here for another minute or so, and then I'm going to get to my lunch. I had the benefit this morning of living up here in Lake Tahoe and Incline Village, and this amazing winter we've had is I, in full disclosure, spent my first 2 hours not in the office this morning. I was on the ski slopes, and it was fantastic. Thank you, Rose. I appreciate it. Well, with that, I guess, Vanya, we'll close it down. Thank you again for hosting. Thank you, everyone, for coming today. It will be on the YouTube channel. Vanya can get you that address. And please do not hesitate to reach out. Send me an email, whatever you want. I'll send you a questionnaire, fill it out, and then I'll get you your analysis. So, yes, thank you, Stephen. Appreciate it. Take care.
Thank you so much.
Bye now, everyone.
Goodbye,
Bye
everyone.
now.
Thank you.